Okay, so we're going to cover bond basics. There are a lot of videos that we're going to be doing on bonds and interest rates and Federal Reserve. So it's important to cover the bond basics. If you can understand everything in this video and retain it and take it with you, then you're home free on all the other videos. Okay, so the way this works like a teeter-totter. IR, interest rates, BV, bond values. If interest rates go up, bond values go down. Conversely, if interest rates go down, bond values go up. This is axiomatic. This is not a debate. This is not a debate of, oh, Microsoft had a good quarterly earning report, I think the stock's going to go up. Well, it may go up. It may not. Some people may view as the stock being overpriced. That's all debate. We're not debating anything. This is linear. So let's take an example. Let's say John has $100,000 and he's going to buy a 10-year bond that pays him 4%. Okay? So that means that in year one, right here, he puts his $100,000 in. If he holds it for 10 years, he will get his $100,000 out, and he will get paid 4% along the way. Now, he can sell it at any time, and we're going to get to that in a second, but I just want you to understand this 4%, this rate does not change. This is called the coupon rate. In the old days, you would literally have a bond sheet that had coupons, and you would literally tear off the coupon, clip it, go to the bank, hand it in, and they would give you your interest payment. That's how it used to work. So that term has never gone away. So the 4% doesn't change. Now, let's say a little time goes by, and Doris has $100,000. And she wants to buy a bond. Now, she hears that John is thinking about selling his bond because he wants to take the money and put a down payment for a condominium down in Florida. So Doris calls up John and says, hey, I hear you might be interested in selling your bond. I'm looking to buy a bond. Tell me about your bond. He said, well, it's a 10-year bond and it pays 4%. Now, at this time, interest rates have gone up. A new 10-year bond, a newly issued 10-year bond is now paying 5%. And Doris says to John, well, I can get a new bond at 5%. Why would I buy yours at 4%? Now, she doesn't know it, but John actually really does want to sell his bond. He wants to buy this condo. So he says, tell you what, Doris, I'm going to give you a break. I'm going to discount the bond. If you give me $90,000 today, when this bond matures and you hold it 10 years, you're going to get out 100. So you're actually going to make $10,000, which should make up for the difference between earning 5% and 4%. And just so you know, this is all math. I'm using round numbers here to make it simple. This is the coupon rate. When you sell a bond in between here, you can determine your current yield, which is the coupon calculated against if you're paying a discount or a premium. And then there's a YTM, that's your yield to maturity. And this is the actual calculations going to tell you how much this premium or discount is going to pay you in real interest rate terms. Okay? So this was a discount, right? Here's the discount. Let's take a different scenario. It wasn't Doris. It was Larry. He was looking to buy a bond. And interest rates, when this happened, interest rates went down to 3%. So Larry hears that John wants to sell his bond. He calls up John and says, hey, I have $100,000 looking to buy a bond. I hear you want to sell yours. Tell me about it. And he goes, well, it's 10-year at 4%. Now, Larry, he doesn't say it out loud, but he's thinking to himself, 4%, that's great. Because current, I can only get 3. So he goes, hey, I'll take it. Now, John has learned some things, right? He's been around the block now. And he says, well, hold on, Larry. I know interest rates have dropped, and you can only get a 10-year at 3%. If you want my 4%, I'm going to charge you $110,000. And if you hold this for 10 years, you're going to get out 100. So you will, in effect, lose $10,000 in principal, but this will be made up because you're earning 4% from me, whereas the current market is only 3%. Okay? And again, current yield and yield to maturity. So this is why the teeter-totter works this way. As interest rates go up in the door situation, bond values go down. So if you're holding a bond and interest rates go up, if somebody wants to buy it, your value is going to be down. You're going to have to sell at a discount. Conversely, if interest rates go down from where you started at 4 and interest rates go down, your bond is more valuable, bond value is more valuable, and you can charge more for it. That's why that works that way. Now, let me show you one thing very quickly, because this is important. And that's the price, what I'll call a pricing wave of a bond. So you could buy a 2-year bond. You can buy a 5-year bond. You can buy all kinds of increment bonds. I'm just using these as a few examples, right? Okay. Now, because of this right here, the bond pricing looks like this. I'm going to do a 10-year just so you can see it. The price moves a lot in the beginning, and then as it gets closer to maturity, it hardly moves at all. And the reason is, for somebody to pay a premium or a discount, they have time here. They have time to earn that money back through the interest rate. But as they get closer to maturity, you run out of time, and so you will see the coupon, the current yield, and the yield to maturity. You'll see all three of those numbers converge and flatten as you get closer to maturity. So a 5-year bond is going to do this, right? Not as big a weight. The peaks and valleys are not as big as a 10-year. 2-year, very little. Okay. And then if you think about it, commercial paper, right? Something that's 30 days, right? If you're putting money in, it's going to come out. That's why commercial paper often used in a money market account. Why are these rates so stable? Well, because from the time you put it in to the time it matures, it doesn't have much of a chance for the bond to fluctuate according to these principles. Okay? All right. Hope this makes sense. If you understand this, then you can watch the other videos and have a lot of fun with them. Okay? Thanks for watching.